Washington. When the debate broke out in 2008 and 2009 about the financial crisis, one of the critical issues was the role of derivatives, the role of commodities trading, and especially the role of what was called excessive speculation. And there's been a lot of debate about just how much does speculation drive up things like food prices, energy prices. Now joining us to talk about that and what public policy might be in people's interest about commodities and such is Michael Greenberger. Michael teaches at the School of Law at the University of Maryland. He was previously, between 1997 and 99, Director of Division of Trading and Markets at the Commodities Future Trading Commission, and he worked for Brooksley Born. He is also a technical advisor for many groups and congressmen. Thanks very much for joining us.
Pleasure to be here.
So let's just start with that basic question. To what extent does speculation or excessive speculation affect the price of energy and food?
Well, as we sit here today, there's little doubt that excessive speculation, that is speculation that's unnecessary to the structure of the hedging markets for food and energy, is causing an inflationary bubble, and the American consumer, and for that matter, consumers worldwide, are paying an unnecessary premium for food and energy, which goes into the pockets of big banks and Wall Street traders and has nothing to do with developing supplies of scarce commodities.
Well, before we explore more what excessive speculation is, what do you consider not excessive speculation?
Well, you have to understand this in a historical context, and it really goes back to the beginning of the 20th century. In the beginning of the 20th century, the only derivative product or futures product that was extant were futures contracts that allowed farmers and consumers of farm products to hedge their pricing exposure. In other words, when a farmer began to plant a seed, he wanted to be guaranteed a certain price when the crops were brought out of the ground. So you could buy what were insurance contracts that gave you a hedge and an insurance for a fair price for the growth of your product. Similarly, those who used those products, for example, bakers and millers, similarly went into those markets to make sure they weren't paying too high a price. And the tension between the consumer and the producer caused the futures markets to be a fair reflection of what supply-demand would designate prices to be. In the beginning of the 20th century, farmers figured out that in the trading venue, which was in Chicago at the various futures exchanges, the traders could manipulate the price up and down by overwhelming the market with speculative bets on price direction. And what the farmers determined, and for that matter the bakers and the millers determined, was they couldn't use these markets as insurance contracts because the speculators were driving the prices in such a fashion that the markets became unusable.
Give an example how that would work. I mean, how does a speculator do that?
Well, a farmer, when they're hedging, is thinking about a fair price to get at the end of the farm season. He needs to interact with the consumer of farm products who wants a fair price as well. The farmer wants the highest price, the consumer wants the lowest price, and the tension between those traders who are forming these contracts makes the price adhere to supply-demand fundamentals. If speculators get involved, they don't care what a fair price is. If they conspire or work together or flood the market, they can say, okay, let's drive the price way up by bidding the price up irrelevant to any economic needs. In those days also, it's not true today, and I can explain why, but in those days also, they would bid the price down and try and short the market. But they were destroying these markets for the use of hedging to protect the farmer and the consumer of farm products, and directly, and the consumer indirectly, who benefited from the tension of this price development mechanism. In the first piece of legislation Franklin Delano Roosevelt sent to the New Deal Congress was a response to this problem, an answer to the farmers' concerns about speculation, and he, in the New Deal Congress, in passing the Commodity Exchange Act of 1936 had a simple resolution to this matter, and that was market by market, limiting the involvement of speculators. To some extent, there is good speculation in that it allows the farmer and the consumer in this market to have liquidity and get in and out of contracts, and the speculator creates that liquidity. But there's a tipping point when there is excessive speculation, liquidity concerns go out the door, and prices become unmoored from price-demand fundamentals. What Roosevelt and the New Deal Congress said, we're going to put limits on speculation in those markets. And from 1936 to the early 90s, those markets functioned very smoothly. There were price variables, but the price variables dealt with supply-demand. For example, if there was a short supply of wheat, the price would go up.
By limits, you mean how much any one party could own or control? Is it similar to what's being called position limits now?
Yes, and it's not a party, it's a person who is in the market who has no need to hedge physical supplies that they are growing or buying. It is people who just want to bet, who don't touch the underlying commodity, but want to bet on price direction. And historically, from 1936 to 1990, a smoothly functioning market, whether you're talking about wheat, or you're talking about crude oil, or you're talking about metals, was 70% commercial handlers trying to hedge their prices and adhering the price to supply-demand fundamentals, and 30% speculators who are in the market betting on price direction but are actually helping the market by assisting the producers in creating liquidity in the market.
So this, for example, is an airlines that hedges their cost of fuel for the year versus that someone's just making a bet.
Exactly. Someone wants to bet on the direction. Now, fuel, jet fuel is not a commodity, and what the airlines use is crude oil as a derivative, so they've hedged in the crude oil markets. But a speculator would go into the market, say, I don't even know what a barrel of oil looks like, but I want to bet it's going to go up or I want to bet it's going to go down. What happened in the 1990s is almost under the radar screen. The big Wall Street banks, beginning with Goldman Sachs, created stealth exemptions to these limitations to allow them to get more heavily involved in the market as speculators, but going under the radar screen. And essentially, the principal vehicle these big banks used, and today the two foremost banks are Goldman and Morgan Stanley, is they wanted to offer their customers the ability to bet on the price direction of food and energy. So they would take in, and they do today, take in bets from customers. Just like you go to a horse race and you go to the betting parlor and you say, I want to bet on a certain horse, they invite wealthy investors to come in and bet on the direction of a basket of 25 food and energy commodities. The bettor does, just like you don't own a horse when you go to the horse race, the bettor wouldn't even know what kind of wheat they're betting on, but they're placing money down, you have to be wealthy to do this, with Goldman, with Morgan Stanley, to bet, and they can only bet that the direction will go up, the price will go up. Goldman and Morgan Stanley now have to go into the futures market, where there are people who are legitimately hedging their commercial bets. They, from 1990 to the summer of 2008, not even going to the CFTC commission, but to the staff, got secret exemptions that allowed them to lay off their risk from their betting parlor by placing offsetting bets in the futures market. Now, if you just follow the thread, Goldman and Morgan Stanley are taking bets from their customers, the price will go up. Therefore, they will lose if the price goes down. They, like a bookie, don't want to be in that position because they're, through their analysts, are pumping up the price anyway. So they go into the real futures market where there are consequences to the transaction, and they bet there that the price will go up to offset the bet with their customers. They got exemptions from the Franklin Delano Roosevelt position limits that allowed them to do it. And their theory was, hey, we're hedging just like the airlines are hedging because we're in the betting business and we're hedging our bets. In the summer of 2008, when oil went to a world record high of $147 a barrel, Democrats in the House of Representatives unearthed all these exemptions and were able to discover that markets that were thought to be 70% commercial and 30% speculative were then 70% speculative and 30% commercial.